Okay, folks, I have 20 minutes to pack in a little bit of a historical journey. I'm going to talk about liquidity fragmentation and the impact of transparency. And to do that in a kind of effective way, I'm just going to show you some basics, which I think many of you will have seen before, in order to sort of like explain the story and how our markets, our FX markets, our equity markets, and indeed our crypto markets got to the state that they're in today. So I'm going to be asking a few questions. The first question is, has technology made capital markets more efficient today? Is transparency, it may seem logical, but is transparency actually beneficial to markets? If we've got these great big exchanges all the way around the world, the Deutsche Börse, the London Stock Exchange, why is it that OTC liquidity, so a liquidity that's not on exchange, is so critical today? And then another question that some of you may have never thought about, but hedging. Why is it that hedging, the activity of hedging, is so relevant to pricing? So hopefully I can answer some of these questions as I talk. Digitization has had a massive impact on markets. If you go back, in fact, 50 years, 1970s, there was no such thing as computer trading. You can see on the left-hand side of this screen, this is what it looks to look like in a trading pit. Orders were called in to market makers. Those market makers were making prices with their hands to gesture buying and selling. That evolved into the banks, the big banks, Goldman Sachs, JP Morgan, Morgan Stanley. They became the market makers, and they had traders with 50 trading screens managing the risk. And today, in today's markets, exness trades $4 trillion per month. We're the largest retail market maker in the world, and we have 0 traders in our company. No one has the title trader, because today 100% of the business is automated. We have people do monitoring roles. So that's the state of play today. So let me just recap. What do I mean by transparency? Most of you, at least your clients, will have seen this before. It's called the order book. And this is what transparency is. The order book shows, on the one hand, it shows the offers. These are the prices you can buy from the market. On the other hand, you see the bids. These are the prices that you can sell to the market. You see quantity. Okay, I'm using Bitcoin as an example here. I know we're a Forex expo, but this is an asset that's on everyone's mind. So I'm using Bitcoin to show you here, but this is volumes. So these are the volumes of Bitcoin or foreign exchange or equities that you can purchase. This is what the order book looks like. So in this example here, you can buy 1.19 Bitcoins for the price of 28,367. Okay? And this is what's referred to as the top of book. This is the best bid and the best offer, often referred to as the touch price. So the reason I'm showing you this is I want to familiarize everyone with what we talk about when we say transparency and fragmentation. So this is the modern markets. This is what traders see. This is what brokers see today. Now, we're led to believe that because all these prices and all these volumes are together, then all participants can trade fairly. That's what we're led to believe. The reality is that you can see those prices, but it doesn't necessarily mean you can execute on them. We're led to believe that these prices are state-of-the-art snapshot of real-time buying and selling in the markets. The reality is, and I'll show you, that these are prices that come from a few exceptionally big market makers, just a few. They don't represent the general buying and selling interests of standard clients. That the best bid and offer is the best possible price. As you'll see in the example, that does not mean best execution, and I'll explain that in the 15 minutes I have left. We're also led to believe that centralized exchanges are the largest pools of liquidity. That's where all of us get our prices from. That's how all of us execute. Again, that's not reality. Most of the important big liquidity is off exchange. Okay, and finally, we're led to believe that when we see these prices, that these are the best possible prices that are out there. Again, that's also not true. And the reason for that is those that are producing the prices they have to add a buffer on those prices because they're concerned about toxicity. They want to have a layer around their prices so they don't get run over by toxic clients. So these are some of the myth busters. So when you look at this order book, you might think about Joe selling to Jane, but it's not. In reality, it's made up of very big, notable market makers. So a good example is Citadel. Citadel here is on the bid and on the offer. Citadel is facilitating buying. XTX, Tower Research, Jump Trading, many of these firms you may not have heard of, but these dozen or so companies, they control the global liquidity across the world that all of us use to execute our business today. So the question is, how did equity markets get like this? And this is a very quick whistle-stop tour. So in the past, again, early 2000s, equities, buying and selling of shares, were dominated by regional exchanges. If you were in America, you were buying shares from the NYSE. If you were in London, you were buying UK stocks from the London Stock Exchange. If you're in Germany, you're doing it from the Deutsche Börse. They had a very sticky position, and their prices were very high, and the banks got pissed off. And so in about 2007, the disruptors entered the market. 3 major disruptors in the UK entered. One called Turquoise, which was 12 investment banks all getting together saying we're going to create our own exchange. One was Chi-X, a new private equity-backed exchange, and then an American entrant from Kansas called BATS. And what did that mean? It meant all of a sudden that British Telecom shares were now trading on 4 venues. So if you wanted to buy British Telecom, where do you buy it from? Chi-X, Turquoise, or London Stock Exchange. It suddenly creates a problem. And so what the big banks did, and this is a term some of you may be familiar with, is they were forced to create what's called smart order routers. Okay, these are highly technical products that banks had to build in order that they could go and get shares from 4 venues at the same time. Because if you look at the screen here, if I've got 20,000 shares of BT on Turquoise and I've got 30,000 shares of BT on Chi-X, and my client wants to buy 50,000 shares, I need to go to 2 venues. This was the start of the electronic revolution, the digital revolution in equities. So you suddenly had this emergence of smart order routing technologies. Goldman Sachs had one, UBS had one, and the reason this is important is it changed the transparent markets. It made the order sizes on exchange really small. It made it difficult for people to buy and sell shares without having market impact. And then you've got the rise of what's called the dark pools. Some of you may have read some of the books, but dark pools were off-exchange liquidity owned by the banks. I use Goldman as an example because it's my former employer and I know about it, but Sigma X was the name of the off-exchange liquidity at Goldman. And so let's just imagine a real-life scenario now. A client comes along and wants to buy 10,000 shares of BT Group. You can see here that every single exchange is showing a bid and offer and a quantity of BT Group. So what happens? Well, Goldman Sachs Smart Order Router, it goes to the London Stock Exchange. It gets the first 200 shares at a price of 117.25. It then picks up another 1,000 shares at 117.26. And finally, it picks up 8,800 shares at a price of 117.28. So the client has now purchased this. By the way, I've translated this from pence to pounds for those of you that are observant. The point is that Goldman Sachs now has used a piece of technology to go out into multiple venues to try and purchase the BT shares. But there's a better price on Chi-X. So for that same BT shares, the broker can go to Chi-X, can get 10 shares at a price of 117, can pick up 9,990 shares at a price of 117.26, and gets a better execution price. And now to my final point around off-exchange liquidity and the belief that markets are the most transparent. In this case here, Goldman Sachs has its own liquidity. It's got 9,600 shares inside Goldman Sachs that no one else can see. So now what does it do? Goldman's smart order router, it takes 9,600 shares from Goldman. It goes to the top of the book, the best price at London Stock Exchange. And then it goes to the best price on Turquoise. And sure enough, the best execution price in the market wasn't the first scenario of one venue. It wasn't the second of a secondary venue. It was actually when a piece of technology went to 3 different locations on order book and off order book in order for the client to get the best execution. That may seem irrelevant, but when you think about companies that are buying and selling billions of shares, if you don't use that kind of technology, then you're going to waste a heck of a lot of money. I mean, literally millions. So that's the equity market structure. That's how we got to where we are. Now let's look at FX. So the FX market structure today, like equities, is disaggregated. It is all over the place. So you have some FX liquidity with the very big banks that are market making. You have a lot of FX liquidity with private companies. You have some on exchange with like the London Stock Exchange, ICE, LMAX, etc. The point is that FX liquidity is all over the place today. So what does the FX market do? The FX market doesn't have smart order routers. It has what's called aggregators. And what aggregators do is they go out, they look at the best price across all markets, and then they display for the client, this is the best price. So let me give you an example. I want to buy 20 million euro dollar. So typically, I would go to the liquidity provider that's providing the best price. So this liquidity provider is happy. They won my order. They got the order. They got paid the spread. They earn a little bit of commission. But that liquidity provider immediately, and you wouldn't know this, that liquidity provider immediately doesn't want the risk on their book. They automatically hedge it away. Maybe they're hedging away 1 million every time. So you've given them 20 million. They've earned a spread. You've saved 2 pips. But every time they automatically hedge that trade back into the market because they don't want it, you're losing 2 pips on every trade. So best price gained you 2 pips on 1 million, and then it lost you 2 pips on 19 million. My point is that even in FX, when you see highly transparent pricing, you can never be sure whether or not it's best execution because it very much depends on the intent of the party that you're executing with. And so finally, and I have 7 minutes, onto crypto markets. And crypto markets, as you know, are the newest form of markets. They're very heavily based around centralized exchanges. The notion of smart order routing, the notion of aggregation, all of these are new concepts in crypto, and they're new technologies that are going to be evolving over the coming period of time. But there is a very dominant liquidity source today for crypto, and that is Binance. It's well publicized. Everybody knows that it's much bigger than anybody else. But let's look at the problems with liquidity. So here's a real market example. Many of you will have heard that BlackRock, the largest asset manager in the world, managing assets for millions of people, has close to $10 trillion of assets under management. BlackRock announced that it's going to do a spot Bitcoin ETF. The effect of that news was a move of 10% in Bitcoin. And this is my Bloomberg showing you that move. Similarly, when you try to execute reasonably large orders on the market, it may not affect our retail clients, but this is impacting our retail clients. But when an institutional client tries to execute reasonably large amounts of Bitcoin on exchange, you can see here, this is an exchange, it's Kraken, in fact. And this is what happens every time a 200 Bitcoin purchase is made. It moves the stock, it moves the crypto 10%. So imagine a situation now where BlackRock has told the world that it's interested in investing into a Bitcoin ETF. Now, given the size of BlackRock, if BlackRock was to take just 0.01% of its assets, so absolutely tiny, to cover an ETF, it would need to trade 188,462 Bitcoins. And you can imagine the impact that that kind of purchase would have on the market. It would be 940 of those 10% moving trades to execute this Bitcoin ETF. So who knows whether or not BlackRock is going to be successful or Fidelity. The point is that the crypto markets are going to have to adopt some of the technologies and the frameworks that we see in equities and FX in order to become more widespread and adopted. So I've taken you here through a whistle-stop tour of market structure evolution over the last 10 to 15 years. I hope you found it reasonably informative. I've done my best to keep it within the time frames. At the very start, I posed 4 questions. And having given you now a quick explanation of my presentation, these are the answers. So the first question is, has technology made capital markets more efficient today? Well, on the one hand, technology allowed the disruption to occur. You saw that. Without a smart order router, you could not have a situation where markets could effectively evolve. And it has had the effect of reducing the cost of trading and increasing the volumes in the market. But on the other hand, what it's really done, it's created a technology arms race, which means that those with the deepest pockets and the most money are the ones that are most successful in trading in capital markets today. The second question was around, is transparency beneficial for markets? I don't think anybody could argue that transparency is not good. In fact, it's a human quality that we like in other people. We like honesty, we like transparency. So when you talk about transparency in markets, it's natural to assume it's good. But as I've demonstrated to you, in equity markets, transparency doesn't necessarily mean best price, because a lot of liquidity is off exchange. In FX markets, best price doesn't necessarily mean best execution. It depends on whether or not the counterparty is hedging. If we've got exchanges, why is the OTC liquidity so important? Well, the reason it's important is that when you are executing fairly large business, and again, our retail clients don't do this, but the institutions do that, and it moves markets, and it has an impact on retail trading. The reason OTC liquidity is so important is it enables institutional clients to trade privately without market impact, which means you don't get big shocks of volatility in the markets. And then finally, why is hedging so relevant to pricing? Well, in fact, many companies, if you don't have a big, strong balance sheet, you might be happy to make a price to a customer, but you may be concerned about holding that risk on your balance sheet, and so you hedge it away. By hedging away your business, in fact, what you're doing is you're having market impact and potentially producing a negative price. I thank you all for listening. I know it's tiring in the afternoon. I may be whining and talking about too much technology stuff. I'm passionate about markets. I hope you all have a fantastic time here. And if anybody has any questions, I can be accessed at the back. Thank you.